The 1929 stock market crash, also known as Black Thursday, stands as a pivotal moment in financial history. It serves as a stark reminder of the risks and uncertainties that can lurk within the stock market, with far-reaching implications for the global economy. In this video, we delve into the events surrounding Black Thursday and its lasting impact on the financial landscape. The 1920s saw a period of unprecedented prosperity in the United States, with the stock market experiencing rapid growth. Investors were lured by the promise of quick riches and engaged in speculative trading, driving stock prices to unprecedented heights. However, beneath the surface of this apparent prosperity, dangerous practices were taking root. Black Thursday, on October 24, 1929, marked the beginning of the stock market crash. It was a day that would go down in infamy, as panic swept through the market and investors scrambled to sell their stocks. The frenzy of selling triggered a downward spiral, leading to a full-blown market collapse. The consequences were devastating, with businesses crumbling, individuals facing financial ruin, and the global economy plunging into the depths of the Great Depression. The 1929 stock market crash was a wake-up call for policymakers and investors. It highlighted the dangers of unchecked speculation and the need for effective regulations to maintain market stability. The lessons learned from this historic event continue to resonate today, guiding us in our approach to financial markets and reminding us of the importance of prudent practices and responsible oversight. In the following sections, we will explore the background and context leading up to the crash, the events of Black Thursday, the causes of the crash, its impact on the global economy, and the lessons learned from this tumultuous period. Through understanding the intricacies of the 1929 stock market crash, we gain valuable insights that can help navigate the complexities of modern financial systems. Background and context. To truly understand the magnitude of the 1929 stock market crash, it is crucial to examine the background and context that led to this catastrophic event. The 1920s, often referred to as the Roaring Twenties, were a time of unprecedented economic growth and prosperity in the United States. However, beneath the surface of this apparent prosperity, dangerous financial practices were at play. During the 1920s, the stock market experienced a period of rapid expansion. Investors, both seasoned and novice, flocked to Wall Street with hopes of striking it rich. The allure of quick profits fueled a speculative frenzy, as people bought stocks with the expectation that their prices would continue to rise indefinitely. This mentality led to the inflation of stock prices, detached from their actual underlying value. The availability of easy credit further contributed to the speculative fervor. Many investors purchased stocks on margin, which allowed them to borrow money to finance their stock purchases. This practice amplified both potential gains and losses, as investors could control larger quantities of stocks than they could afford to buy outright. Unfortunately, the economic prosperity of the 1920s was built on shaky foundations. The stock market boom was not accompanied by an equivalent growth in wages and production. The disparity between the soaring stock prices and the stagnant real economy created an unsustainable situation. In the next sections, we will delve into the events of Black Thursday, the fateful day when the stock market tumbled, the causes of the crash, the impact it had on the global economy, and the lessons learned from this pivotal moment in history. By examining the background and context leading up to the crash, we gain valuable insights into the dynamics that precipitated the downfall of the market. The events of Black Thursday. Black Thursday, October 24, 1929, marked a critical turning point in the history of the stock market. It was a day that would forever be etched in the collective memory, as the stock market plummeted into chaos and triggered a chain reaction of devastating consequences. On that fateful day, the stock market opened with a sense of unease. Rumors of potential financial instability and the realization that stock prices were artificially inflated had begun to circulate. As the trading day progressed, fear gripped the hearts of investors, leading to panic selling. The volume of selling orders overwhelmed the market, creating a downward spiral that was impossible to contain. Prices plummeted, and investors desperately sought to unload their holdings before they became worthless. The selling frenzy triggered a catastrophic collapse, with the stock market losing billions of dollars in value within hours. To exacerbate the situation, margin calls were issued. Investors who had purchased stocks on margin were required to repay their loans immediately or provide additional collateral. As a result, many were forced to sell their stocks at whatever price they could get, adding to the downward pressure on stock prices. The events of Black Thursday marked the beginning of a deep and prolonged economic downturn. The stock market crash sent shockwaves throughout the economy, leading to bank failures, business closures, and widespread unemployment. It was the beginning of the Great Depression, a period of immense hardship and economic despair for millions of people. In subsequent sections, we will explore the causes of the 1929 stock market crash, the impact it had on the global economy, and the lessons learned from this historic event. By understanding the events of Black Thursday, we gain insights into the fragility of financial markets and the catastrophic consequences that can arise from unchecked speculation and market instability. Causes of the stock market crash. The causes of the 1929 stock market crash were rooted in a combination of economic factors and risky financial practices that ultimately led to the catastrophic event known as Black Thursday. Understanding these causes is crucial to grasping the full extent of the crash and its enduring impact on the global economy. One of the primary factors contributing to the crash was overspeculation. During the 1920s, a speculative frenzy gripped the stock market, as investors sought quick profits by buying and selling stocks based on the belief that prices would continue to rise indefinitely. This led to a rapid inflation of stock prices, detached from their actual underlying value. Another significant cause was the widespread practice of buying stocks on margin. Investors were able to borrow money to finance their stock purchases, allowing them to control larger quantities of stocks than they could afford to buy outright. While this practice magnified potential gains, it also amplified losses. When stock prices started to decline, investors faced margin calls, which demanded immediate repayment of their loans or additional collateral. The lack of effective regulation and oversight was another crucial element. The stock market was largely unregulated during this period, allowing for risky practices and market manipulation. Institutional investors and financiers took advantage of this lax regulatory environment to engage in speculative trading and manipulate stock prices for personal gain. In the following sections, we will explore the impact of the crash on the global economy, the events leading up to Black Thursday, and the lessons learned from this historic event. By examining the causes of the 1929 stock market crash, we gain valuable insights into the dangers of unchecked speculation, the need for responsible regulation, and the fragility of financial markets when risky practices are left unchecked. The impact of the crash. The 1929 stock market crash, also known as Black Thursday, had a profound and far-reaching impact on the global economy. Its repercussions extended beyond the confines of Wall Street, leaving an indelible mark on businesses, individuals, and nations worldwide. One of the immediate consequences of the crash was the onset of the Great Depression. The collapse of the stock market sent shockwaves throughout the economy, leading to a sharp decline in consumer spending, business failures, and widespread unemployment. As businesses struggled to survive, millions of people found themselves without jobs, exacerbating the economic hardship. The effects of the crash were not limited to the United States. The interconnectedness of the global economy meant that the shockwaves of the stock market crash reverberated across borders. International trade plummeted, as countries faced reduced demand for their goods and services. The global economic downturn deepened, and nations around the world experienced significant economic contractions. Financial institutions were also severely impacted. Bank failures became commonplace, as individuals and businesses were unable to repay their loans. The lack of confidence in the banking system further worsened the economic crisis, as people rushed to withdraw their savings, leading to a loss of trust in financial institutions. The 1929 stock market crash served as a stark reminder of the inherent risks and vulnerabilities within financial markets. It highlighted the importance of prudent financial practices, effective regulation, and government intervention during times of crisis. The lessons learned from this historic event shaped subsequent financial regulations and influenced economic policies for decades to come. In the following sections, we will explore the causes of the crash, the events leading up to Black Thursday, and the lessons learned from this pivotal moment in history. By understanding the impact of the crash, we gain valuable insights into the fragility of the global economy and the necessity of proactive measures to safeguard against future financial crises. Lessons learned. The 1929 stock market crash, commonly known as Black Thursday, remains a watershed moment in financial history. The far-reaching consequences of the crash have left an enduring impact on the global economy. From the ashes of this catastrophic event, valuable lessons have emerged, shaping the way we approach financial markets and regulation. One of the key lessons learned from the crash is the importance of sound financial practices. The speculative frenzy and over-reliance on unsustainable market growth were clear indicators of the dangers of unchecked speculation. The need for responsible investing, based on thorough research and a realistic assessment of market conditions, became evident. The crash also underscored the necessity of effective regulation and oversight. The lack of regulatory safeguards allowed for risky practices and market manipulation to thrive, contributing to the collapse. As a result, policymakers recognized the need for stricter regulations to maintain market stability and protect investors. Transparency and disclosure became vital considerations following the crash. The opacity of financial markets and the lack of reliable information contributed to the panic and confusion during the crash. Greater transparency and accountability were emphasized as essential components of a healthy and stable market environment. Additionally, the crash highlighted the interconnectedness of the global economy. The ripple effects of the crash spread rapidly across borders, demonstrating the need for international cooperation and coordination in times of financial crisis. The crash served as a catalyst for greater collaboration among nations to mitigate the impact of future economic downturns. The 1929 stock market crash and Black Thursday left an indelible mark on financial history. The lessons learned from this pivotal event emphasized the importance of responsible investing, effective regulation, transparency, and global cooperation. By heeding these lessons, we strive to create a more resilient and stable financial system that can withstand the challenges and uncertainties of the future. Conclusion. The 1929 stock market crash, commonly known as Black Thursday, stands as a stark reminder of the inherent risks and volatility within financial markets. This catastrophic event, which triggered the Great Depression and had far-reaching global consequences, continues to serve as a crucial lesson for investors, policymakers, and economists. Black Thursday highlighted the dangers of unchecked speculation and the unsustainable belief in perpetual market growth. The crash exposed the vulnerabilities of an overinflated stock market and the risks associated with buying stocks on margin. It became evident that sound financial practices, based on thorough research and responsible investing, are essential for long-term market stability. The crash also emphasized the need for effective regulation and oversight. The lack of proper regulations allowed for risky practices and market manipulation, contributing to the collapse. As a result, new regulations were implemented to protect investors and maintain market integrity. Furthermore, the crash revealed the interconnected nature of the global economy. The ripple effects of the crash spread rapidly, demonstrating the importance of international cooperation in times of financial crisis. The crash led to a greater emphasis on global coordination and collaboration to mitigate the impact of future economic downturns. In conclusion, the 1929 stock market crash and Black Thursday remain significant milestones in financial history. The lessons learned from this historic event continue to shape our approach to financial markets, regulation, and economic policies. By understanding the causes and consequences of the crash, we strive to navigate the complexities of modern-day financial systems with prudence and awareness, aiming for a more stable and resilient global economy.